Hey, everybody, it's your boy, Sean McLaughlin, at Options Sean on the old Twitter X. What's today? Today's Wednesday, January 14, 2026. I'm not used to saying 2026. I got to get used to that. I'm not there yet. I hope you guys are doing well. This is the What Are My Options show. This is we can call it office hours. We could call it Ask Me Anything. It's an opportunity for you to get into my head about options trading. If you have questions about, oh, hold on, got a little music coming in there. So, sorry. It's your opportunity to ask me questions, to get into my head and find out what it is that you need to know about options. If you want to talk about a particular strategy, if you want to talk about uh, how to when to exercise options, when to get out, when to take profits, all that stuff. We can cover all of that. And I'm trying to look for the chat here. I seem to have lost the chat on my screen here because I want you guys to be able to hit me up in the chat. So there it is. I got it back. Okay. So I see you guys are in the chat. We will get to your questions. I see some people asking about some tickers there: Credo, Palantir, Amazon, Meta. I see a few of you guys in there. But before I jump into that, guys, I want to talk about options execution. This doesn't get talked about enough. All right. And we have talked a little bit in the past about, when you're trading options, you want to always use limit orders. Okay. You never want to put a market order out for an option, right? Because generally speaking, options have certainly wider bid-ask spreads than stock does, right? And it's not uncommon for a option that has a fair value of, let's say, $2 a contract. It would not be uncommon for the bid to be 175 and the offer 225. Okay. The fair value is still $2 in that scenario, but the spreads are wide. And if that fair value option is $2 and you put a market order in to buy, you're going to get filled at 225. Now that might not sound like a big deal, but that's $25 extra that you paid per contract. That's a big commission, right? Don't ever do market orders for options, even in the most liquid ones like I got or like the SPY, right? Even in those options where the bid ask spread is usually a penny wide, especially with at the money options, I do not recommend using market orders. Always use limit orders. I know it takes a little bit more work and you got to be a little bit more patient, but it pays for itself over the long run. So this is on my mind here because I've had a couple questions over the last few days that are worth exploring. And so let's do this real quick. I want to use some real world examples. I've got some positions that are expiring soon here. Let's see. Let's do Cenex. Um, I have some January options that are well in the money. You can see right here. I'm long the January 34 calls. The stock is trading at $47. These are way in the money, right? Now, anyone who's in a trade like this, they might look at this bid ask spread. Look at this bid, 1170, offer 1530. You might look at that, it might make your head explode. Like, oh my goodness, the spread is terrible. I'm going to get a terrible fill. Well, in the example of deep in the money options, especially as you're approaching expiration, if you're holding these things, what you need to know is that when an option is deep in the money like this, the option will trade at its fair value, or sorry, its intrinsic value. Now, what is the intrinsic value? The intrinsic value is how far in the money the option is. So these are 34 strikes, right? So with the stock trading at 47.65, that means this stock is $13. Yeah, $13.65 in the money. Now it's 62. So if I were to put an offer in to sell this stock or sell this option at 13.65, I am reasonably confident that I will get filled immediately. If I don't get filled immediately, I could lower my offer down by 5 cents, by a nickel, and I'm pretty sure I will get filled. Why? Because for a market maker, it's free money, right? If I put an offer out to sell this at 13.60 right now, remember, market makers can move a hell of a lot faster than you and I can. In fact, most of it's just done by computers, right? So market maker, if I were to put an order out to sell this at say 13.60 with the stock trading at 47.62, they're going to fill me at 13.60, immediately sell stock against it at 47.62, capture that 2 cent difference, that's free money. For them, that's $2 for the effort, all done by computer, right? They're going to do that. And they do that. All right. So when you're holding deep in the money options, whether they're calls or puts, don't let the bid ask spreads freak you out. If you're looking to get out of this thing, don't put a market order in to sell it at 1170. You're giving up $3. Don't do that. Don't do that. That's a terrible fill. All right. Figure out what the intrinsic value is. In this case, it's 1365 or 1362 is the actual intrinsic value. So you put an order in for 1365 or 1360, you'll get filled. Please do that every time. And so don't worry about deep in the money calls. I have some people asking me, I have some positions on in my short-term options strategy that are deep in the money, like this CENX, and they're worried about getting filled. CM is another one. All-Star Option subscribers are in CM. We've been in this thing for a long time. That's Canadian Imperial National Bank, or Canadian Imperial Bank of Commerce. That's what it was. We have some deep in the money calls there. Same situation. People are worried about the bid-ask spread. Don't be. You can get filled at the intrinsic value. There's no premium left in these options. When they're deep in the money like this, there's no premium. So that's one thing I wanted to talk about options execution. The other thing I wanted to talk about in options execution is, let's just bring up, I don't know, how about Apple? Everybody likes to trade Apple. Let's say I wanted to buy Apple. This is hypothetical. I haven't even looked at the chart. I don't know if it's a trade I want to do. But let's say we're looking at May options and I want to go out of the money and I want to buy these May 290 calls because they've got a 25 delta. Okay. The bid is 510, the offer 520. So sure, I could hit the offer and get in for 520 right now. I think it's a bad choice. The better choice would be to put a limit order in at 515 and see if you can get filled in the middle. You'll likely get filled, especially in a liquid name like Apple. But what I often do, guys, and sometimes it's more effort than it's worth, but I believe that it pays off for me in the long run, is I like to work my orders and I would like to work in from somewhere better than the mid price. So if I was trying to buy these calls right now that are bid 510, offered 520, well, it just changed. Let's find some of the little wider spread here. No, we'll still use the example. It's bid 515, 520. So the mid price is 517 and a half, which of course you can't get. Well, if I was trying to buy that right now, I would put a bid in. It's now at 510 now. I'd put a bid in at 511. I might get filled. Often, I mean, I shouldn't say often, but I've been filled often enough to make it worth it, right? If I get filled at 511, I'm already ahead in this trade because the fair value is 515. I'll put a bid in at 511. I'll let it sit for a minute, maybe less, maybe 30 seconds. If it doesn't get filled, boom, I'll update my price. I'll change my price to 512. If that doesn't get filled, I'll update to 513. And I'll keep going all the way to 515. At 515, I'll probably get filled. I'd be surprised if I didn't. But I might get price improvement if I start lower and work my way up. Now, that's not for everybody. If you don't want to do that work, just put the order in at the mid price, 515. You'll get filled, 8 times out of 10. And if you don't get filled, then you improve your price a little bit. But never, if you're buying options, never pay the ask. And if you're selling options, never pay the bid. Just don't do it. Don't do it. Okay. You're giving free money to the brokers. All right. And you never know. Sometimes you'll get some amazing fills. It doesn't happen often, but sometimes there might be a stock or an option that you're trying to buy that's bid $1 and offered $2, right? And if you put a bid in for $1.10, it's happened. I've gotten filled before, and the bid ask spread doesn't change. It's still $1 by $2. And then maybe I could offer out at 150 and get immediately filled and have a quick flip for a quick, easy profit. Right. But be patient with your orders. Always work your orders. Use limit orders. If you're buying, put your bid in just above the best bid and work your way towards the middle. And that's how I do it. All right. That's how I do it. That might not work for everybody, but that's how I do it. All right. So let's see. Let me scroll up and let's look into the questions here. I see, by the way, shout out to all of you here. Jackson, Traz, Vip, Harminder, Richard, Robert. Shout out, everybody. Good to see you. I'm glad you're here. All right, let's go in no particular order here. Well, I guess we'll just go from the top. Jackson wants to know about Credo and Palantir. Let's start with Credo first. Man, we had a great trade in this one last year, or 2014, I think it was. Got a big, well, maybe it was in this run right here. I don't know, but there was a big winner we had in this one not too long ago. All right, so what are my thoughts on this one? Well, for me, I don't know. Credo is kind of it's in the no-fly zone for me. It's kind of, I mean, it doesn't look very particularly bullish. It doesn't look particularly bearish either. I mean, gun to my head, this looks like an iron condor candidate, right? The stock can kind of go sideways for a while. I would get interested on the long side if it broke above, let's say, 176, above this peak here. I mean, that's being a little bit more aggressive. I mean, really, the breakout would happen above 196. That's really where it's time to get aggressive. If you're a momentum trend following trader like I am. Conversely, if you want to get short, below, I'd say 128 would feel like the level to get short. But for me, gun to my head, I'm putting on an iron condor in this trade. An iron condor, for those of you who don't know, it's a delta neutral trade. It's a trade where you collect premium up front. You're selling an out of the money call spread. You're also selling an equally sized out of the money put spread. You're bringing in credit, and your bet is that the stock will continue going sideways. And if it does, you will make money because you could buy that spread back for cheaper than you sold it for as those options decay away as they stay out of the money. So that's my thought on Credo. Well, let's look at Palantir. Same story, exact same story with Palantir. I want to see it. I want to see it do something first. You can see I've already got an alert in here. I've got it on my watch list as something I would buy if it gets above 196 and a half, basically. I would be a buyer there. I would potentially be a seller below 153. The nice thing about below 153 is you get below this shelf of support here in August as well as November. But then you're breaking the 200-day moving average, which that's pretty significant. So I'd be looking to get short below 153-ish, and be looking to get long above, let's say, 196 and a half. But same story as Credo. Gun to my head. If I had to put a trade on right now, Iron Condor, baby. Iron Condor. Get paid to wait. All right. All right. Traz is asking about Amazon. That's the Mag 7. Many think will rip next. Well, only price pays. That's the only thing that'll tell us if it's ripping, right? Um, I don't like the way Amazon's trading right now. You can see I've got an alert to set to tell me that I'd like to get in above 255. I think I might update that now. I'll update it with you right now. I'd get long above 250, I think. If we can, I mean, the last 2 days have not been very good, right? Amazon to me is a wait, a wait. Wait till it gets above 250, then you could start dabbling your toes in. Volatility is rising, as you can see here, probably because we're starting to approach earnings season here for Amazon. I'm sure that has something to do with it. I'm sure there's more reasons, but implied volatility is high. So if Amazon were to stabilize here and trade back to 250, likely we'll see volatility come down a little bit. I'd like to see it come down a little bit more meaningful before I just buy simple calls. If volatility remains high in Amazon, probably have to do something like either sell a put spread, or if I want to be a little bit more aggressive, maybe buy a call spread, a bull call spread where I'm buying, let's say, the 260 calls and selling a higher strike to minimize my impact, my cost impact. But right now, Amazon is a wait for me. It's a wait and see. We'll see what's up. All right, Viper says, thinking of selling puts in Meta. What do I think? Let's see. Let's see. Let's see. Well, volatility is rising. That's one check in favor of that. Let me just pull up the earnings date on this. I got to look on another platform here, so I apologize. I'm moving away from the screen, but give me one sec. Pull up Meta. Earnings date is February 4, so we're pretty close on that. We're looking at what, 3 weeks away on earnings. So here's my thought on Meta. Volatility is rising, so that's a good time to sell puts. It's not extreme. It's good. We have some support here around 575. Let's take a look at what the options look like in February. February expiration, which is February 20th. So we would have to ride it through earnings, of course. All right, but let's see. if the 575 strike offers some good premium, let's check it out. It does offer some pretty good premium. Well, premium is relative, right? You could sell these 575 puts for 1260, let's call it. But, in terms of, let me bring up my trusty calculator here. 1260 divided by the share price of 617 times 100, you're getting, is that right? 2%? Okay, you're getting 2% of the value of the underlying. All right, that's not bad. I stand corrected. I stand corrected. Did I do my math right? Let me do that one more time. 2555 divided by 616. Oops. Yeah, okay. 2%. All right. That's an acceptable put to sell. I like this, when I'm selling out of the money puts, I want to get at least 1 to 2%, generally closer to 2% of the value of the underlying. Now, here's the thing, and this is so important, so important. When you're selling naked puts, you're basically on the hook, right? If this stock craters, you're on the hook to buy that stock at 575 per share. All right. If Meta trades down to say 450, you're going to take a loss. You're going to take a loss similar to the same loss that a stockholder would take. All right. Less the premium you collected. So you'll save a little bit on the premium. But you're still open to big losses. So you have to, if you're going to sell naked puts in a stock like Meta, it has to be a stock you're willing to own. Okay. That's number one. If you could put this stock, you have to be willing to own it. Number two, if you get put the stock, you damn well better position size that position in a way that it does not overtake your portfolio. So what I mean by that is, if I'm on the hook to buy at 575 because I've sold the 575 puts, okay? I want to make sure that if that position gets assigned to me, that the cost of that stock, that means I'm a buyer of stock at $575 a share, no matter what price the stock is trading at in the real open market, right? Stock could be trading at $400. You're still buying it at 575 because of the put that's going to get assigned to you. I want to make sure that if I get assigned, let's say it's 100 shares of stock, right? I sold one put. If I get assigned one put equals 100 shares. So 100 shares times 575 is what, $57,000? Is that right? Yeah, $57,000. That's fine if you have a large portfolio, okay? My rule of thumb is whatever the cost of the assignment is, whatever the cost of the shares, in this case, it'd be $57,500. I want that $57,500 to be worth no more than 10% of my total account value. Why do I use that number? I use that number because in an absolute worst case scenario, it's probably not going to happen in a name like Meta, but in an absolute worst case scenario, if you invested 10% of your portfolio in that stock and that stock goes to zero, your portfolio took a 10% hit. Now that sucks. Nobody wants to take a 10% portfolio hit, but a 10% portfolio hit is a hit you can come back from. Okay. You can lick your wounds, go back, go meditate, go for a walk, figure out what you did wrong, write your lessons down, internalize your lessons, and come back from that. Okay. But once you start taking portfolio losses that are larger than 10%, once you get into 20 and 30 and 40 and 50% losses in your portfolio, that's when it becomes very, very hard to earn your money back and to get back to even. And nobody wants to trade just to get back to even. We want to trade to win. That's why we trade. Okay. So if you sell naked puts in Meta or any name, number one, make sure it's a stock you'd be comfortable owning if it got put to you. Number two, size the position so that an assignment will not cost more than 10% of your portfolio equity. Do we understand each other? Give me a shout out in the chat if you do, please. All right. All right. Harminder says, worst thing is when I see the price enter the order and the order doesn't get filled and it just sits there. Yeah. Going back to the execution piece, sometimes with options, especially if they're not like the most liquid options, sometimes you got to be patient. You got to put your order out there and you got to be patient. I've earned some patience over the years. I've become a little bit more patient. In fact, let's show some let's example some patience right now. I just had an alert pop up on my screen. It's a stock I'm in and I want to get out of. I got some in the money calls. All right. I'm long the 42 calls in January. The stock's trading at 55. So these are worth 1330 right now. Okay. We got a big bid ask spread, right? Is that, am I doing my, yeah, they're worth 1330. So I'm going to put an order in to close this right now, but I'm not going to put it at 1330. I'm going to put it at like 1350 and I'm going to walk my order down. All right. So look at this. I put an order out at 1350 and look at that. I got filled at 1350, 20 cents better than the intrinsic value of that option. Boom. How great is that? See, that's why you put your order in better than the mid price or better than the fair value because you never know, you might get filled. And I just got filled. Awesome. Hope you guys enjoyed that little interlude. All right, let's go back to the questions here. Am I out of AXP? Yes, in All Star Options, yesterday we exited both American Express positions we were in. We were in both a calendar spread and a bull call spread. We exited both of them as Amex closed below our level. In fact, I'll show you here. Let me pull up the chart. AXP. When we my stop level was 360, you can see there, and we closed below it on the 12th. So what was that? That was Monday. And so yesterday, the day after, is when I closed the spread. So we're out. We had two trades on. We had a bull call spread that we paid 15.25 for. I got out for 7.05, and we had a call calendar. Or no, sorry, 15.25. I sold it for 9.50. And we had a call calendar spread on that we paid $7 for, and we got out at 4.50. So, you know, both those positions were sized in a way that if I took 100% losses, they would have been a 2% hit to my portfolio. But I took less than that, as you can see. So all good, all good. All right. Let's see. Question. This is from Traz. He's new to options. When I try buying puts, they don't move as I expect. What am I missing? Maybe I'm picking contracts with too much IV. No problem with calls. Puts seem to move less. Well, without having some concrete examples to see what the issue is with the puts, generally speaking, and this is not always true, but generally speaking, if a stock is moving down, like for example, this AXP right now, right? This stock is moving down dramatically for the last 3 days. When that happens, the premiums and puts tend to rise. All right. And all else being equal in a normal market, a put that is an equal distance away from the strike or from at the money as a call, or let me say that better. A put that is equally far away as a call is in either direction, the put will generally have more premium than a call. So for example, let's say we're looking at $100 stock. Stock's trading $100. The 90 put might cost $5. The 105 call might cost $3. And you're like, what the hell? They're the same distance away. The reason is, well, there's two reasons. Number one, people tend to pay more for puts because that's downside protection. That's protection they're scared of. People are willing to pay that insurance. Okay. The other reason is on the call side, a lot of people do covered calls. A lot of people, more than you might think, especially in big cap names. And so there's a constant pressure, there's a constant selling pressure on out of the money calls by people who are selling covered calls against their long stock. That artificially keeps prices down a little bit. And there might be other reasons, but those are the two biggest reasons as far as I'm concerned, is that people are scared of the downside, so they're willing to pay more for puts, and they're selling calls, and that makes calls cheaper. So what that means for you, Traz, is that there's more premium in a put, generally speaking. So if you don't get the move you're looking for in a timely fashion, then you're swimming upstream against theta decay. Theta decay is what's dampening your P&L swings. All right. So that's just something to keep in mind. Buying puts can be hard. Buying puts is a tricky thing. I don't like to buy puts unless I have spotted an opportunity that is being underpriced by the market. And how do I know if it's being underpriced? I look at IV. All right. Let me bring my Thinkorswim chart back up. I look at Like here, this pass that I just sold. I mean, look at this chart here at the bottom, this blue line, that's implied volatility. Right now, implied volatility is at or near the highest levels it's been all year. You know what? This is a bad example. This is a metal. Metals tend to, people get worried about the upside. The stock's been going up crazy high, so they're worried about the upside. But regardless, it doesn't matter. Implied volatility is high right now. People are paying high prices for puts. I don't like to pay high prices for puts. Let's see. Let's bring up a stock like Caterpillar or Home Depot. Okay, there you go. So here's Home Depot. You see implied volatility is it's off the lows, but it's still pretty low. And if I'm looking at Home Depot chart and saying to myself, this thing's a fade. This thing's going to fade all day. This thing's going to come right back down to 340. If I believed that, then this could be a good candidate for buying puts because implied volatility is cheap right now. Puts are going to be relatively cheap. You're not going to pay a whole lot of premium. And so you're not going to have the theta decay as bad as you normally would. So something to consider there in Home Depot. Or sorry, something to consider when you're buying puts. So Travis, I don't know if that answers your question, but yeah, puts and calls move differently sometimes. And it has a lot to do with the implied volatility. Oh, hey, Jay, I didn't even know you were asking about Home Depot, and there we are talking about Home Depot. Jay says, "Do I like it? Price now above 200 and the 200 week what's that? The simple moving average." My total brain fart there. I totally froze. Would you get involved now or wait until it breaks? You could see I have an alert at 415 is where I would give up. I don't like it here as a long. I mean, maybe for a very, very short term trade, you can maybe catch a pop in this thing, but I don't know. For now, on my time frame as a swing trader, I don't know if I like it. I'd like to see it consolidate a little bit more before I maybe buy. Like if it consolidates here and goes sideways for a couple weeks, maybe I could buy it above 380, maybe. Um, but yeah, I have no strong feeling about that one at all, Jay. But Michael Anthony wants to know what is happening to you today. Well, I can tell you what's happening to you, and you could tell it too. The price is going down. The only thing that matters is price. Only price pays. I don't give a shit what the reason is for. I don't know why it's happening. I don't care. Price is down. I don't like it. If I'm in this, I'm hurting, and I am in this. In my All-Star Options portfolio, I've got a long position on in this one, and it's getting hurt, and that's no fun. Let's bring that up. Let's take a look at it. Yeah, I'm along a call calendar spread, so at least the pain isn't going to be that bad. But yeah, it's below my stop. My stop is 43.50. It's likely going to close below that today. So tomorrow morning, I'll be getting out of this thing in all likelihood, unless we see some monster stick saving a beauty here on the downside. But yeah, I'm looking to get out of this thing. I'll be getting out of this thing tomorrow, Michael, if it doesn't recover. If it closes below 43.50, I'm out. Why is it down? I don't know. I don't care. Short CRM. CRM kind of stuck in the muck here. I think if you want to get aggressive, you can get shorter below 234 would be the aggressive short. If you want to be a little bit more conservative, wait till it gets below 223. But yeah, Salesforce just can't seem to get out of its own way the last couple of years, man. All right. Well, guys, it's 10:30 my time. I'm in the mountains. 12:30 if you're out east, 9:30 in Pacific time. If we have any more questions, I can hang out for a couple more minutes if you want. But otherwise, it looks like I've exhausted all the questions. I think we've covered some good topics here. Execution, options execution is very important. You can't be sloppy with your options execution, guys. You can't just be throwing market orders out there. And you guys saw, I gave you guys a perfect example with my PA, with my pass exit, right? Like, be patient, work your limit orders, and you might get better. You might get price improvement. All right, let's see. I mean, boy, I'm feeling real good about this thing now. Where did I sell it? I sold it at 1350, and look at it now. It's trading at, well, right now it's worth let's see, it's 42, so it's worth 1325. I got it at 1350. I feel great about that. All because I was patient and I worked an order above the mid price and I got filled. Awesome. Super Bowl winner, Joey. Let's go Bills. Let's go Bills. I'm in Colorado. They're coming to Denver this weekend. I'm very excited. I'm taking my boy down there. We're going to go see the game. It's going to be awesome. Go Bills. That's my Super Bowl take. All right, folks. That's all I got for you. Thanks for tuning in to What Are My Options. We'll do it again next Wednesday, same time, same channel. I'll be back on Stock Market Media TV tomorrow at 3 Eastern with the All-Star Options Jam session, where we review open positions in the portfolio, update some stops, talk about any adjustments we're making, any exits we've taken, whether for a win or a loss, all that stuff, plus my market take. Tune in tomorrow, 3 Eastern. I'll see you then. Take care, everybody. Be well.